Lehman Brothers filed for bankruptcy on September 15, 2008, which was subsequently the beginning of the Great Recession that nearly upended the economy of the entire world. However, 6 days before the fourth largest investment bank of the USA with 25,000 employees, $639 billion in assets and $613 billion in liabilities collapsed. Global rating agency Standard & Poor's (S&P) had accredited A rating to the company. Moody's waited even longer, downgrading Lehman one business day before it collapsed. The movie The Big Short, starring Steve Carell, addressed the issue as to why the credit agencies continued to give inflated ratings to nearly bankrupt companies. The answer was simple. The companies could have thrown their money to a different rating agency and garnered the required rating. Even after failing on the biggest stage, the supposed sharp-penciled bunch of tuxedo-wearing global analysts of rating agencies continue to rate the rating based on political affiliations and personal profits. And the biggest target of them continues to be India. Hi and welcome. This is TFI English, the national socio-political analysis arm of the TFI Media Group. I'm your host Tribhuvan, and in this video I will tell you how India successfully defied the myth of global rating agencies with mammoth FDIs. Let's begin. Reportedly, Fitch Ratings has kept India's sovereign rating unchanged at BBB with a negative outlook owing to a rise in public debt ratio and uncertainty on debt trajectory. The rating remains unchanged from April this year. Meanwhile, Moody's last year had downgraded India's foreign currency and local currency long-term issuer rating to Baa3 to Baa2, which is the lowest grade for a sovereign. There's no beating around the bush that the Western world, where the majority of the global rating agencies are stationed, has a bleak outlook on India, stemming from preconceived notions. To them, India continues to be a third world country where animal poop on the street is universal occurrence while people live in shanty, dilapidated kacha houses. And to an extent, they cannot be blamed for it. For a superior intellectual economist political predecessors sold such an idea of India on the global platforms. It is, however, changing with the Modi government at the helm of the affairs, as the country's GDP has bounced back sharply, nearly reaching the pre-COVID numbers, and the stock index Sensex scaling unprecedented heights, all the while government introducing reforms such as production-linked incentives, also known as PLI scheme, under its Atmanirbhar Bharat campaign. While the rating agencies continue their shoddy work, the investors with global and domestic continue to give them the cold shoulder and pump prime the Indian economy. Despite the UN Conference on Trade and Development report stating that global FDI flows plunged by 35% due to COVID, FDI in India increased by 27% to $64 billion in 2020 from $51 billion in 2019. Talking about 2020, India has attracted a total FDI inflow of $22.53 billion during the first 3 months of the financial year, that is from April 2021 to June 2021, which is 90% higher as compared to the first 3 months of 2020 to 2021. Automobile industry has emerged as the top sector during the first 3 months of financial year 2021 to 22, with a 27% share of the total FDI equity inflow, followed by computer software and hardware and service sector respectively. As reported by TFI, bullish on the health of the economy and expecting rich future dividends, foreign investors are continuing to bet on the Indian market. Reportedly, within the first 10 days of September, foreign portfolio investors have poured in a net sum of rupees 7,605 crore rupees in the Indian market. While 4,385 crore rupees was pumped into equities, the rest 3,220 crore rupees was pumped in the debt segment during September 1 to 9. The investors have picked up from where they left in the previous month, as FDIs were net buyers of the tune of rupees 16,459 crores in August as well, with the majority of investment coming in the debt segment. In layman terms, FPI refers to investing in the financial asset of a foreign country, such as stocks or bonds available on an exchange. The FPI flows are only expected to increase as India presents higher growth opportunities, which the global investors can no longer ignore. Even after a devastating second wave of pandemic, the Modi government managed to wade through the testing water and is now reaping the rewards for it. The reform-laden approach has been the cornerstone for this success, as investors ignore the doom and gloom rating of the credit agency. The government of India fully understands the partisan behavior of the global rating agencies. Earlier this year in January, the Modi government released the Economic Survey 2020 to 2021, The survey right off the bat criticizes the low ratings of India and China, with historical data and references. The economic survey reads, never in the history of sovereign credit ratings has the fifth largest economy in the world been rated as the lowest rung of the investment grade. Reflecting the economic size and thereby the ability to repay debt, the fifth largest economy has been predominantly rated AAA. China and India are the only exceptions to this rule. China was rated A- or A2 in 2005, and now India is rated BBB- Baa3. Do the fundamentals that supposedly drive sovereign credit ratings nationalize this historical anomaly? In this chapter, the survey asks these important questions and answers a resounding no. Today, countries like the United States raise debt at an interest rates near zero, while India, owing to the prejudice of the rating agencies, has to pay over 5% interest rates. However, such has been the groundwork laid down by the Modi government that unperturbed foreign investors continue to pump the liquid cash. On the domestic front, the GST collection for August crossed the 1 lakh crore mark, after doing so in July as well. The gross GST revenue collection stood at rupees 1,12,020 crores, which is 30% higher than the previous year, indicating that the economy was indeed recovering at a faster pace. All the indicators suggest that the Indian economy is recovering at a miraculous pace, and if nothing, the growing trust of the global investors to pump their money into Indian markets is a solid endorsement of PM Modi's economic policy. The global rating agencies can continue to scribble their unintelligible toddler ratings, trying to remain relevant.